So that was the start of it, where it was really a public policy decision to change the standard banking model or financing model where individuals earned the right to have the mortgage and earned the right to pay it back, where now it was a free-for-all. On top of that, and what happened there was the bankers are obviously uncomfortable, so Fannie Mae and Freddie Mac, quasi-government institutions, purchased the mortgages. Then we had the monetary policy post 9/11 where they opened the floodgates for liquidity, which is the right thing to do. Like the tap in your tub, they forgot to turn it off. So we ran with low interest rates and flooded the system around the planet, literally, with money. So what we have there is a lot of money floating around, trying to find a home, a broken risk prudence model for the lenders in the States, pushed by the politicians, and people starting to clamor for higher and higher returns on their money. So they want higher yields. You don't want 1% and 2% in a savings account. So then that's when the Wall Street types walk in, the trained MBAs with the suspenders and the calculators, and come up with a lot of sophisticated instruments. And the instruments, of course, included securitization of these subprime mortgages. The problem with that also is that if you securitize your assets, the bank, the standard model for banking is originate and hold. I talk to Mr. and Mrs. Smith, we grant them the mortgage, we look in their eyes, and they pay us back for 25 years, and they live in the community with us. So you know your client. If you originate a loan with the intention of immediately selling it, it's only human nature that your risk prudence will go down. You'll pay a little less attention knowing that that's not something you're going to have to live with for the next 25 years. Then the securitization also sort of starts feeding on itself because the banks, getting back to the capital basis that the banks have, you start churning your capital base. If you just lend for a 25-year mortgage, that capital is allocated for 25 years and you earn money on that. If you can sell that loan and then you can redeploy that little sliver of capital you had against it, and you start churning your capital base, which drives up your profits. And everyone knows in the corporate world, the short-term performance pressure is fairly intense. So to argue that you have a 20-year view, you wouldn't be around very long. You need to get your short-term interest and your profitability up. The other problem is with all this huge, who keeps track of all this stuff? When you have a securitization and then you lump all these mortgages together, get a credit default swap, get a monoline insurance policy, then you sell slivers of this as an investment vehicle to people who want to invest in it. You start losing the clarity of what's really behind all this stuff. You can see the yield on the face of the paper, but you don't know who's paying that money. And if it's a lot of subprime mortgages that are really a bit of a sham, then you lose track of where all this stuff is. And the problem is with the frozen ABS market in the States, in Canada, is that even companies and individuals who buy this stuff really don't understand what they're buying. And when it's frozen, their money is frozen. And then you can't pay your payroll and you can't pay the bills. So that's the problem we had. We had, in the early years of this century, too much money running around, searching for higher yields, sophisticated instruments, the human tendency not to want to appear stupid, so no one asks, I don't understand, explain this to me again, and no one asks, what is the risk underlying all this mess? So we had a perfect storm. Exacerbating that was also the tendency to over-regulate in the face of a catastrophe, and we had the mark-to-market rules under accounting in the wake of Enron and WorldCom, where assets that have illiquid value, they can't be sold readily, there's no market for them, need to be written off. So the problem there is you got to ask yourself, if no one was available to buy your house in the near future, is that house worth zero? Of course it isn't. So that's the argument, particularly in the Canadian banking system in the last year, when we've also had to write down some of these assets we hold, a very small percentage compared to other banking systems, because by virtue of the size of the Canadian banks and our involvement in the international market, we're naturally going to end up holding some of this stuff along the piece anyway. Our argument's always been we write off 100% knowing full well that the thing is worth at least 80 to 90%, but we can't do anything about it because the accounting rules brought on by regulation force us to say it's worth nothing because no one will buy it from us right now. So the banks, after they took these massive write-offs, are busy trying to recapitalize. That's why you always hear them running around trying to get new capital issues issued, sovereign wealth funds trying to invest in them so that they can then turn around and start lending again. In the States, the $700 billion bailout was premised on buying these mortgages, toxic mortgages, off the balance sheet of the banks so that they would give the banks money, buy the assets, hold them in a resolution trust too of some description, and then the money the banks had would start flowing back out. Secretary Paulson the other day, of course, announced that they've sort of changed direction on that. Instead of buying the mortgages, they're going to invest in the banks directly. Just like you would have a share in a bank, the U.S. government will own probably preferred shares in the U.S. institutions. That probably is a better idea because, as I explained, it's the direct capital of the bank that creates the lending momentum. If you just hand the bank money for a toxic asset, it does free up the capital associated with that asset, but that doesn't necessarily mean they're going to start lending $700 billion. But if you invest $10 billion, then they invest start lending out 10 times that amount. Finally, I'm back to the credit markets. I didn't hear a bell yet, did I? Pretty close. Quick. Financial crisis means, is there a credit crisis in terms of availability? Is there a liquidity crisis? And more importantly, is there a confidence crisis? You may have seen in the press at least one, if not two, institutions, the World Economic Forum, rated the Canadian banking system as the soundest banking system on the planet. That's probably no accident, but it's something we'll take credit for anyway. Oh, here's where I have to put up slides finally. Okay. Confidence. This is a volatility index, and we've seen something similar already. But what this basically tells you, and you can see on the right-hand side there, that means people are estimating that the stock market will either be up 80% or down 80% 1 year from now. That's a safe bet. I just want to quickly touch current government actions. So we've already heard a little bit about that. In the States, it's been a little more extensive. As I said, instead of buying the mortgages, now they're going to buy shares in the banks and to see if that will recapitalize the banks and get them moving. In Canada, we've heard, you hear a lot about interbank Libor guarantees. As I mentioned, the wholesale market around the planet, it's called really the Libor market, which means London Interbank Offered Rate. So they set a rate of lending between banks. So we have surplus money overnight, we hand it to another bank overnight, they pay us interest, and then we get it back a day hence, 2 days hence, 3 months hence, whenever we need the money back. So there's a huge pool of money that flows around the planet, but the second we start having the investment banks and some of the other banks in the States failing, all of a sudden you don't trust your banking brothers anymore. So the cost of interbank lending has exploded. This is a good proxy for interbank costs of funding, how we fund ourselves. Of course, we fund ourselves by paying money on your savings accounts, we pay money on the wholesale market. So the banks, that 3% that it costs us to fund the loans, is a wide variety of instruments that all add up together. But this is called the 3-month TED spread. So you can see, basically, the banks lend to each other about 10% or a little less than 10%, but then all of a sudden in 06, 07, 08, it has exploded. So even after 9/11 or the Russian crisis, none of that had the same impact as now. So the banks don't trust each other anymore. So that's why the governments around the world, including the Canadian government, have now instituted an availability of an insurance policy that you can buy, it costs money, so that you can insure the money you're lending the other banks. So to make sure that you don't wake up one day and they can't pay it back to you. So the governments are trying to free up that wholesale market where the money can start flowing again. The Canadian government announced mortgage purchases, went from $25 billion to $75 billion. The banks really didn't ask for that. We'll take it, but I mean, what they've done is they're going to buy from us CMHC insured mortgages. So the government's already explicitly guaranteed those mortgages. So the risk to the government doesn't change. They've bought it off our books. We re-lend the money. So it creates liquidity in the market. The money flows into the banks. It flows back out in new mortgages. Equity injections, the U.S. is going to do that. A lot of countries around the planet are going to do it. We don't want it. We don't need it. because the second the government starts buying into the banks, then the banks are effectively nationalized. Deposit insurance, we heard Premier Campbell announce that the credit unions were going to have 100% coverage by the BC government. That's just an extension of what other provincial governments have done here in the West and in the Maritimes. Probably no big impact on the Canadian banks. We already have CDIC insurance of $100,000. You can multiply that at any given institution by 3 or 4 times based on the number of legal entities we have. So not many people have more than $400,000 in cash to insure, so it's probably not a big issue. CDIC insurance, basically, it's funded by the institutions, so the largest institutions pay the most premiums. And so ironically, it's inverse. The largest institutions are usually the strongest institutions, and so we pay for the insurance for everyone else. So right now, what's the local credit conditions? Very strong. Everyone keeps asking me, are we lending money? And I tell them we have never been busier. I can talk for the Royal Bank only, really, at this point, but our credit approvals are continuing. We are still authorizing new loans. I guess I can't say the number, but the same magnitude as they have been over the last several years. So the number of loan approvals we're giving hasn't changed. We have growth targets for next year. Even though we think the Canadian economy is going to slow probably only to 1% for the overall year average versus the 0.6 on the screen, the Royal Bank says 1% right now. First 2 quarters negative, second 2 quarters recovering. But we have personal growth targets in the bank quite a bit higher than that, which means we acquire clients from other banks. Credit standards. Are credit standards tightening? I don't want to say they're not tightening. At the Royal Bank in particular, they remain unchanged. Our credit standards, and that's why the Canadian banking system is strong, really stand the test of time, and they remain the same. The only thing that's changing is the flexibility that sometimes robust economic times afford you in terms of bending some of your own rules. So are the rules going to be bent quite as often? No, but our credit standards have not changed. So someone mentioned to me, do you have credit rationing? And I always picture a cabal of people sitting around threatening to cut off small business or something. In almost 30 years in the bank, and 5 of those in head office risk approval, I've never been called to a meeting where they said we're going to restrict credit, so they must not invite me to those meetings. So that's a bit of an urban myth. There's not credit rationing in the sense of we're going to cut off this industry or we're going to cut off that industry. Our credit standards don't change. In difficult economic times, we're not quite as anxious to bend the rules to accommodate individual clients, but we still stand by our credit standards, which has, as I say, held us in good stead. Victoria, sorry, 2 seconds. Victoria, I can tell you we've had 1 home foreclosure this year, a trailer in Souk. On the business side, 0 write-offs. Yesterday I looked at the reports, 0 delinquencies on the business side. Not one business that deals with the Royal Bank in Victoria is delinquent on its payments. I was thinking the other day, what does all this mean? I said, people are kind of reacting the way you do in a human emotional model to a crisis or a catastrophe or a grief, the Sarah model. The shock, anger, rejection, acceptance, and hope. You go through all those stages. Shock, we've all been through. I mean, a couple years ago, people were probably had their calculator out and figuring their investment book. They'd be lunching with Bill Gates before the year was out. That's not going to happen. Anger. Right now, we're in the hunt for the guilty stage. That's popular in the bank, too. And the one comment I'd make on that, going back to the Community Reinvestment Act of the late 90s, and all political stripes promoted that, to see the legislature and the politicians in the States dragging the bankers, and most of them deserve it, but dragging them up and pretending that it was just Wall Street greed that was the cause of all this mess, reminds me of the old saying that my mother told me, life is short, try not to be too much of a hypocrite along the way. So to sit there and express shock and dismay that someone greedy on Wall Street caused all this mess is a little strong. We can take away his Ferrari, we can kick him to the curb, but let's all stay in this together. I think we're pretty close to acceptance and hope. Our view right now, Canada is insulated, not immune. I mean, we have an unbelievably strong economy, very low unemployment. Unemployment will obviously tick up a bit. Growth will slow. We right now view at the World Bank that the first 2 quarters of the year will be contraction. Second quarter, the third, fourth quarter recovery for an overall increase next year of maybe flat 1%, and then moving back to our long-term potential of just shy of 3% after that. Things can change, as we saw from the volatility graph. Could be 80% up, could be 80% down. But I think, you know, we have to remember that, you know, we live in just an unbelievable country, and we're kind of all in this together. It's too late to run for the exits now anyway, so we might as well just hold hands and head down the path together. Thank you.